The October 11th, 2011 meeting of the Finance Committee of the City of Santa Barbara will now come to order. Any comments from members of the public on items not on today's agenda? Seeing none, we will go to our presentation. Mr. Samario.
Sure. Thank you, Mr. Chair, members of the committee. We're here to go over our self-insurance programs, and Mark Howard, our risk manager, is going to be doing all the talking. I just wanted to mention that this is something we actually do every year. We don't bring a report as this to the council, but always to the Finance Committee. And even though there aren't many changes from year to year, our programs and our coverages are pretty consistent. We may tweak them here and there, but they're pretty much the same as they were last year and the years before. But you know, if you only hear it once a year, you tend to forget it. And I think it's important information for you and the public, and really everybody in the city, to understand kind of how our insurance programs work, what we cover, what we don't. So I think it's just a good educational process for all of us every year. And so anyway, with that, I'm going to turn it over to Mark Howard, and he will start the presentation.
Great. Thank you, Mr. Howard.
Thank you, Chairman Francisco. We're here to talk about insurance program overview, and yes, you've probably seen this and remember this from last year, so we'll move along. This first part is more about education. It's the history and overview of the program. We will talk about where it started, what are the elements of the program, and then the funding piece, how the city funds the self-insurance program, and then we'll get into the program details covering workers' compensation, general liability, and the property and miscellaneous insurance policies. So going back, in 1974, the City Council established the self-insurance fund to account for the workers' compensation program. The city did not start actually handling self-insured claims until 1978. In 1976, City Council amended that program and included general liability in the self-insured function. And these programs are accounted for in what we call an internal service fund, where each of the departments and operations pay a premium to fund this self-insurance fund going forward. The program elements: workers' compensation program. This program provides benefits to injured employees in accordance with federal and state law, those employees that are injured or have an illness out of the course and scope of their employment. The liability program conducts investigations regarding incidents and damage claims that happen based on city operations. We also try to correct potential hazards before claims or damages occur, and there includes loss prevention training specifically on automobiles. Every year we provide defensive driver training courses. We also have, as part of our operations, the occupational safety and health function for the citywide operations, trying to ensure a safe work environment through training, screening, and safety analysis for all our employees as required and mandated by state law. We also provide monthly what we call injury and illness prevention program training, and I'll get into more details of that later on in the presentation. Summary of appropriations. As you can see, the fiscal year 2012 self-insurance fund budget is just shy of $5.3 million. 79% of that involves claims and insurance, the largest piece being the workers' compensation piece, at 33% of that total. Liability, insurance, and claims take up 24%, and property and other miscellaneous insurance programs are 22%. The next largest piece is salary and benefits, which only equates to 10% of our total budget. And then the supplies and services that we provide to the operating departments, 9%, and allocated costs make up the balance. So each operating fund, including enterprise and other restricted funds, pay a premium based on its payroll for the employees that it has in its operations, the fleet of vehicles and vessels that it operates, as well as the buildings and floor plan space that it occupies. The fund is overseen by the Risk Management Division, and we use the premiums collected to pay claim costs, sponsor any loss control programs to reduce the frequency and severity of claims, and purchase limited amounts of commercial insurance, and we'll get to those towards the end of the presentation. So we're going to start with the workers' compensation program. The city maintains a self-insured retention, or an SIR, for the first $750,000 per claim. That means that those payments are made out of our operating budget. If Joe employee has an injury, the first $750,000 will be paid out of my operating budget. The city is part of a joint powers authority called CSAC for excess workers' compensation insurance up to $1 million above our SIR. Then CSAC, on behalf of the city and its various members, purchases excess insurance above that level to what they call statutory insurance. California law requires an employer to pay for benefits under the workers' comp program without a monetary limit. So if somebody has a rather severe injury, it's never capped off at the amount of money it goes. We are obligated to pay for all benefits until that person is well and taken care of. So for fiscal year 12, excess insurance premiums through the CSAC program were $164,917. The next couple of charts show what our workers' compensation program has seen in results on frequency and severity over the past 10 years. And you can see that over the past 10 years, our frequency of claims have dropped dramatically. When you look at when the city actually began self-insuring and funding its claims, as we talked earlier, City Council established the program in 1974, but we actually didn't take over the daily operation of the workers' comp claims until 1978. So during that period of time, 1978 through fiscal year 11, our historical average is around 260 claims a year. As you can see from this chart, in the last couple of years, we've dropped to 50% of that historical average. I can't claim responsibility for those results, but I can tell you who should feel the responsibility for that, and that is our supervisors, who part of our IIPP, they are the person responsible for safety in our organizations. So between our supervisors and our operating employees, they're doing a better job at doing their work under the safe work parameters. That's why we have these kind of results. The next chart shows the severity of those claims, and you'll see that in fiscal year 2002, where we had, going backwards, we had 216 claims in fiscal year 2002, down to 138 in fiscal year 11. You'll see that in fiscal year 2002, those 216 claims spent over $3 million on those claims. Whereas in the past fiscal year that just ended, fiscal year 11, we're estimating by the time all those claims close that we will spend less than $1 million, a drastic difference.
Mr. Howard, could I ask a question about that?
Sure.
So it looks like in recent years the trend there was around 1.4, 1.3, 1.5, bouncing around there. Do you expect that to be the average going forward, or is there a reason for those two dips to 700 and 900K that we could hope to replicate?
Chairman Francisco, I can tell you that those claims in fiscal year 11 in our parlance haven't fully developed, meaning some of the more severe claims still have time to develop, and those costs will rise.
Okay.
The less expensive claims will drop off with less money. Will it go past the 1.5 range? I'm estimating no. So is our actuary. We do an actuarial study to trend that out every 2 years.
Okay.
And they're trending downward based on our claim frequency rates. So do I see it going back to the $3 million range? No. Back to the 1.5? Likely.
Okay, great. Thank you.
You're welcome. So under the workers' compensation program, we do employ loss prevention and control techniques to try and minimize any claims that do happen. We have what we call an IIPP, which is the Cal OSHA acronym for an Injury and Illness Prevention Program. This is written policies and procedures on safe work practices that apply to multiple departments throughout our organization. It includes training, medical screening, and return to work programs. That written document contains most of the safe work practices, but each of the operating departments will expand upon that for the things that are unique to their operations. For example, in our IIPP, you'll find things about emergency medical care, first aid, CPR, but you won't find something on the safe work practices regarding a firearm. That's unique to just one operation here in our organization, so that those will be handled internally by that department who uses a firearm. We have safety committees both at each department level. Some departments that are larger and have more diverse operations may have multiple safety committees within their department. We also have a citywide safety committee that reviews requests from both the operating departments and general employees on things that they see throughout their workday. Some issues to consider about workers' compensation insurance going forward. Using the self-insurance model, where we are self-insured for the first $750,000, that insulates us from the instability in the insurance market for the most part. A company who would go out to the insurance market every year and buy what we call first dollar coverage would be subject to the whims of the insurance winds of the day, meaning sometimes the insurance might be more expensive or less expensive. This is our way of trying to moderate any swings upward or downward. What we see going forward and what I'm hearing through the grapevine in the insurance industry is that workers' compensation costs may rise 5 to 10% in the next fiscal year. The two main reasons are health costs continue to rise, and they have been for about 8 years in a row now. And lately, the number of companies offering workers' compensation insurance at this excess level where we purchase it, the number of those companies providing that coverage are diminishing going forward. One of the larger providers announced that they're not going to write business in California beginning in January of 2012. So that may be problematic for us going forward.
Any questions from committee members on this area before we go forward? Mr. White.
Thank you, Mr. Chair. How does this compare to other jurisdictions? Do others insure themselves first dollar coverage? Is that pretty common, or is this model one that's looking around the state or the region? Would we find this to be a similar package?
Councilmember White, the vast majority of cities of our size are doing just what we are, self-insuring. The cities that would buy first dollar coverage mostly are the smaller entities where self-insurance is not prudent financially. But at our size, it is very prudent financially to remain self-insured because our costs would be much higher if we went to the insurance market to buy first dollar coverage. How do we compare to other cities? We periodically do benchmarking studies, and we find that we are never the best and never the worst. We're in the upper percentile of where we're supposed to be, and finding that is pretty standard throughout the times we've done those benchmark studies.
And then secondly, before 1974, were we first dollar covered at that point, and or not? And now that was when the self-insurance kicked in after that? Is that how that
Yes, we purchased first dollar coverage, and as a public entity, we are only allowed to buy first dollar coverage from one location in 1974, and that was from the State Compensation Insurance Fund. Okay. And we did buy that first dollar coverage through them. We switched that to a self-insurance model for 4 years before taking on a full self-insured model in 1978.
Thank you, Mr. Chair.
Anything, Mrs. Self?
Mr. Howard, just one comment. If I could have a pie chart, it would be interesting to see, you mentioned the fact that each of the departments pays premiums into the insurance fund. It would be interesting to see just a chart of what those amounts were, how much each department contributes in terms of premiums. I think that'd be useful going forward. Thanks.
So now we're moving on to general liability. And the city is self-insured for the first $1 million in general liability, meaning that any claims that we pay for trip and fall, vehicle collisions and the like would come through our operating budget up to a first $1 million. After that, the city participates in a separate joint power authority called Excel, where that pool shares losses for an additional $4 million above the $1 million. And our contribution this year for fiscal year 12 for that is $477,000. That joint power authority also purchases excess commercial insurance above the $5 million level up to $50 million. And our premium for that is $228,000 for a grand total of $706,000 for general liability excess insurance. Program details for the general liability, our office adjusts the claims. Typical examples include trips and falls, sewer backups, water main breaks, or damage caused by city staff when they're doing their job, digging a hole, knocking down somebody's fence, that type of thing, as well as auto liability claims. To minimize that exposure, the liability program also administers what we call a fix-it program. This is an opportunity for members of the public or even members of our operating departments to notify us about hazards that they see on city premises. We will then take that information and forward it to the proper person to do the maintenance and repair and follow up that it's done in a timely fashion. And as stated previously, the liability program also administers the fleet safety section of our injury and illness prevention program. Every March, we offer city employees the opportunity to attend defensive driver training courses to improve their driving skills. We find that very useful. And again, we got a couple of charts. From fiscal year 2002 through fiscal year 11, you'll see that the liability claims, unlike the workers' comp claims, have not had a flat line or even decreasing line. They've been kind of up and down. And you'll see that the good news is that the number of claims has dropped precipitously over 10 years, which is good. Because as you'll see, we'll go back, fewer claims mean fewer dollars out the door. So all I can say is our fix-it program and our maintenance efforts throughout the organization are doing their job, reducing our claims. This is a look at the coverage limits that we have purchased over the years through the Excel program. The City of Santa Barbara was one of the founding members of that Joint Powers Authority called Excel back in 1986. And it started off with 6 members, and it grew to a current 11 members, where we were sharing risk above $1 million and capped at $9 million. And as you can see, we've expanded that coverage over the years to where we are currently and have been for the last several years, with sharing risk with our 11 other sister cities, only up to the $5 million level, and then purchasing insurance up to $50 million. So with the issues and considerations under the general liability program going forward, these markets remain unstable. These are the big dollar types of losses that you would see, and there are a lot of things that we'll talk about when I get to the property insurance issues and considerations that are quite similar. That when there are large losses, they are very large, much like the gas pipeline that exploded about a year and a half ago. They're estimating that loss to be somewhere north of $60 million, probably closer to $160 million in losses. And those types of losses make it difficult for us to purchase insurance as a consortium. We're expecting to see rate increases 5 to 10% in the next fiscal year, just because of those types of issues.
Okay.
So,
Any questions on this section? Mr. White.
Thank you. I didn't get the allusion to the gas pipeline. What?
the analogy there is that when an insurance company has to pay out large dollars under this umbrella of general liability, that makes less money available to go out and insure other folks.
There was an incident in Northern California.
Okay, there was an incident. in
Oh,
North
I'm sorry.
California.
Yeah, there was an incident in Northern California in the Bay Area
Okay, I remember
where
that. Okay.
a gas pipeline
Right,
was
I do
punctured
remember that.
through a
San-
public works
San
project.
Bruno or somewhere.
San Bruno is
Great,
the...
thank you.
Yes.
Mr. Howard, one other question. That chart on claim costs, it said within SIR, were there claims outside of SIR during that period that would have been much
Chairman-
higher peaks?
Chairman Francisco, I am happy to say that we have not paid any claims above our SIR through the self-insured program since its inception.
Great. Okay.
So, to date,
Okay.
knock wood.
All right. Thank you.
No. So now we're on to property insurance. City owns a variety of property, more than 380 buildings, and they are all covered under our property program under what we call an all-risk program. So it covers things like fire, flood damage, wind damage. We call it all risk. That all risk means everything shy of earthquake. We'll talk about that separately. What we do not purchase is insurance to cover infrastructure, things like sidewalks, bridges, pipes, dams, conduit, and the like. With 388 buildings, adding infrastructure would make the cost of property insurance probably unpalatable to not just me, but to the council members as a whole. So that's something we've historically not undertaken just based on pricing alone. All risk coverage, as I said before, fire, wind. We have a number of what we call boilers and machinery in the insurance industry. In other words, if there's a heating source and a vessel, they call it a boiler. Whether it's truly a boiler anymore or not, those of you that lived on the East Coast probably saw boilers as your heating source for a number of years. In the last 5 or 6 years, our coverage has also included what we call excess terrorism, the post 9/11 requirement. Last year and currently, coverage was expanded to include cyber coverage so that there's any loss relating to our computer systems. It's covered, as well as any damages that are incurred under the all-risk portion when we have to do repairs. Any increased cost to upgrade to green building standards are covered as part of the loss. So that is something that is consistent with council's direction on being more of a green building city. Our total insured values for property insurance, as you can see, $467 million worth of properties. The standard deductible for a property loss is $50,000, except for Stearns Wharf. You'll probably understand why when you think back of what the history of Stearns Wharf has been. But the Stearns Wharf deductible is $250,000. Coverage limits are capped at $1 billion in losses. And our premium for this year was $451,000 to maintain that coverage. In addition, I skipped something. So, where's my? I'm going to come back to that in this slide. Earthquake is a separate coverage that we purchase on our property. We have different property values for the earthquake because we eliminate things such as fleet items, boats and automobiles, trucks, machinery from that. And we have a deductible of 5% per location, which in this case would be per building. If, for example, at our wastewater treatment plant, we may have one location as a wastewater treatment plant, but we'll have a dozen buildings there, so any damage will be, any deductible will be per building. So it's 5% of that cost, subject to a $100,000 minimum. We currently maintain dedicated limits solely to our city operations only at $50 million. If you look up there, our limits are $50 million, but our total insured values are far greater than that. And for that, we pay a premium of $774,000. By far the biggest piece in our property insurance premium is the earthquake coverage. So I'll go back to that previous slide. The issues and considerations, the rates may increase 5 to 10% next year. You may wonder why, and then you have to think back to earlier this calendar year, where worldwide we've had several very extreme heavy losses in the property insurance area, beginning with floods in Australia and ending with 2 rather large earthquakes along the Pacific Rim. We need to look at what our actual values are. We have not updated the appraisals on the vast majority of our buildings in a long time. So we've been doing minor incremental increases. What types of coverage do we really want to keep? Do we really want to increase our earthquake coverage to better represent total values or not, and what's our appetite for risk. And the reality is that at some point we're going to utilize this coverage, but to what extent, and what is the value of that to us today in premium dollars? It's all subject to our thoughts and responses. What would happen after an earthquake? Yes, we might get assistance from FEMA. Those of us that have worked with that program know that it's not going to come today or even within 6 or 8 months after the loss. That's one of the reasons why we continue to purchase earthquake insurance, because we know that we can access those funds immediately. FEMA's funds may come several years down the road on a reimbursement basis. We may get some assistance from CalEMA that might come sooner or later, but with the current state economy and state budget workings, who knows when that really will show up. The downside to having a loss that's covered by FEMA or CalEMA is the requirement that we maintain coverage for that type of loss, whether it be flood, earthquake, or the like, on that specific location in perpetuity. So we would have to then list those specific buildings as covered under the earthquake policy or our all-risk policy. So the types of premiums by line of coverage, we paid $2.1 million in insurance premiums this year. As you can see, property insurance, both the all-risk and the earthquake, 57% of that $2.1 million. Liability was 33%, and workers' comp only 8%. And then there's several other insurance policies that make up 2% of the balance. We'll go over those really quickly. Airport insurance, annual premium of $20,000. That premium decreased in fiscal year 12, as well as the marine liability annual premium, $16,000. That one decreased as well for fiscal year 12, unlike the other larger ones that went up. It was very helpful in me trying to balance our internal budget. And we also maintain what we call an employee dishonesty or crime policy. We are obligated by California law to have this bond or fidelity coverage for specific employees, including city administrator, city treasurer, city clerk, and others, but we also expand it to include anyone who handles cash. And that coverage costs us a little over $6,500 a year. And with that, we come to the end of my presentation, unless there's any questions.
Okay. Any questions from committee members? Mr. Howard, I have one question.
Yes.
Could you go back one slide? The airport and aviation insurance, what does that cover?
Chairman Francisco, airport and aviation is a piece of our insurance policy that we are required, since we operate the municipal airport. Our general liability program under Excel excludes airports as a covered entity. So we are required to gain that coverage somewhere else unless the city wants to take on that exposure itself. So we purchased this policy that provides, in essence, first dollar coverage for trips and falls and those types of operations at the airport itself.
So is it just liability?
It's just liability.
Okay. All right,
It does
thank you.
not include any coverage for actual aircraft, since the city does not own any actual aircraft.
And the airport buildings are separately insured?
Correct.
Okay. Mr. White, did you have a question?
Thank you. I find this area, even in my own personal world, is just one that's confusing and discomforting. I never know when I'm getting exactly what I need. And I'm curious how the city goes about vetting or scoping its needs and confirming. I'm presuming it's an ongoing process year in and year out to adjust and manage as time goes by. Could you describe a little bit the vetting process, or what you would do or what the city does to scope its needs for insurance and for managing risk, I guess is a better way to put it?
Councilmember White and members of the committee, that's one of the things that is an added benefit of being a member of the Excel risk-sharing pool. I get to participate in regular meetings with my counterparts at 11 other California cities of similar size with similar operations, and we bounce ideas off each other routinely at those meetings as well as via email and the like. The city is also using an insurance broker who specializes in municipal operations. That is their major forte in the insurance industry. So as people like myself and my colleagues ask more questions about our operations and how can we best cover the cities that we represent, those folks then get to go out to the insurance markets and create those types of programs that will help municipal operations best. So there's a lot of collaborative type things that are going on a regular basis.
Thank you, Mr. Chair.
Any other questions? Okay. Thank you very much, Mr. Howard. Mr. Samario, meeting adjourned.